Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful when the world's on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you got a good spot. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun.
All right. Good morning, everybody. Well, today is Tuesday and we got a CPI here in about 3 minutes. Hold on a second. I got bring up the. You can hear the music. I can't hear the music. I think. Man, I don't know when this happened. Last night, you know, I did a bunch of coding, and then I went to bed. And this morning, it looks like a kid had maybe restarted my computer. And I'm like, when did they do that? There was never a time when it was just open. Well, anyways, so we got the music going. So, CPI. We're looking for a CPI year-over-year reading of 3.7. And headline US CPI month-over-month, spot 6. Core CPI month-over-month, spot 3. So now, remember last month, the headline was 0.9. But the core was 0.2. And the market is going to care a lot more about the core CPI. Because we know oil, Iran, all this stuff, we know that that's going to be high. Okay. But what we care about is that core number. Right? Like, is that inflation bleeding out into everything else? So the market's going to be really paying attention to that number. If it's higher than the expectation, I mean, spot 3 is usually it's spot 2 or spot 3. We actually kind of want it to be spot 3. If we got a spot 4, I think that would be, market would react, you know, negatively to it, but I don't think that it would be too bad. If we get a spot 5, then it might be like, oh no, it's the apocalypse. On the other hand, if we get a spot 2 again, then they gonna buy this thing, probably. Granted, with any kind of a trade like that, we would also have to consider that there's a high risk of Iran headlines right now. All right, so got everything ready here. 10 seconds. Okay, it is spot 4. So interesting. I mean, in my book, that's a sell, but they are not selling it. The headline is in line, spot 6. So I'm always, one of the things that I'm doing here is I'm saying, like, what is my expectation? Like what, this comes in and they say, okay, expectation spot 3, previous reading spot 2. But that spot 3 is like the analyst expectation. And there's like the analyst expectation, there's a market expectation, and there's my expectation. Well, in this case, I think my expectation was spot 3 or spot 4. The market was probably expecting it to be a little bit hot because if we come back to the chart, we were selling off into it, right? So it seems to me they were hedging themselves for it. So it seems to me that even though we got a number that was hotter than the analyst expectation, that because the market anticipated it and already hedged themselves, we don't get a massive down move from it. And now you might see this sort of people covering those positions, taking profits on them sort of a thing. Interesting. There was a 9K there at 05 half. Okay, well.
Block buy.
They they bought through. It wasn't nearly 9K, but they still took a big block to get through it, right? I think that's profit taking. Let's give it a few minutes. Let's give it like 5 minutes, and then we'll go through the higher time frame charts. So I got a muffin. We'll eat the muffin. Okay, so just coming over the wire, some guy I've never heard of before in the UK is quitting the UK government. So I think we have to be aware of a possible government collapse over in the UK. This is something that can often happen as too many high-level people decide to quit, and then that forces a no-confidence vote or something like that. Okay, so to the charts. Here on the 10-year, we are not quite below where we were on May 5th, but it's looking pretty ugly. We are down overnight, although we are recovering. How much of this was hedging for CPI versus concerns about tensions flaring back up in Iran? Unclear. By the way, how much of a change? Okay, about 15K net. Recovering what was sold. Here's the S&P 500, still looking mighty fine here, and that is just amazing run. Oil is a little bit higher, so that there's definitely, I think this ZN probably the bulk of that is oil. Here's gold. Not too big of a change in gold. They lost a little bit of their rise from yesterday. Silver, you know, looks more like a pullback, but man, that buy in silver was amazing yesterday. Here's copper, looks just as amazing. And the Japanese yen. Oh, was there intervention overnight again? Interesting. And the dollar is at what, 98.11 on my chart at least. And Bitcoin, well, they've maintained their gains, but they're just still kind of sitting pretty. You know, what's funny to me is that the Bitcoin chart is just always kind of boring to me. like even when it really goes down, it doesn't look as impressive as some of these other assets when they pop off like silver. Well, anyways, so that's where we're at. Good recenter right there. I never said hi to everybody. Good morning, Kevin, Andre, and Schroeder. So, well, yeah, let's go into this. So yesterday we were having a discussion, which was basically arguing about whether certain influencers are profitable or not profitable, right? I still maintain that I have never been given a complete 5-year record of a profitable trader that day trades. Like it's all day trades, 5 years, profitable after 5 years. Never seen that. There's lots of people out there on social media that are claiming to be, or that people think that are, but without that information, how do we verify that they are? Well, there's maybe a few. There's one or two that I actually think have made money, but I think the reason that they're making money is that they are pump and dumping. Basically, they buy it, they push it to their stream and their followers, they all buy it, and then they sell off of that rise. So if you're watching a influencer, they're trading very illiquid stuff, and they've got like a chat room where they're pushing their trades and trying to get everybody to follow them. Be very, very wary of that. But anyways, one of the names that came up yesterday was Tom Hougaard, who I'm honestly not that familiar with. I knew that he wrote a book and everything. I didn't know that he was like on YouTube and stuff until a couple of months ago. And I read some things from him. Somebody had gone through and like tracked all of his trades for a month or whatever, and like in a spreadsheet, and the trading wasn't very good. Well, what a coincidence. Yesterday, somebody on Reddit posted this. The title is, from r/day trading, what the fuck is Hogarth doing? Well, I'm at a loss with that guy today. He trades these mechanical opening moves trying to catch early momentum, which I effing hate, to be honest. Where's the skill in that? Where's the mindset? He calls them espressos. He took an inevitable loss in DAX doing that this morning, and then lost another in FTSE with a regular trade. After that, as far as I'm concerned, he went nuts. And this is the guy who wrote the book on how to lose properly. A little later, he was over 6 times his normal size in FTSE short at one point, even though it hadn't moved into profit by more than a dozen or so points. It got into trouble, so what did he do? He went and had a cup of tea with a friend. During that time, it recovered, went 20 points in profit, then retraced again into a massive rally, meaning that he missed the win and took an oversized loss. So what was his response? Immediately re-enter in the opposite direction, only to take a loss on that too. Then came the US session, and it was just loss after loss after loss. This isn't variance, it's nothing more than tilt. He destroyed 2 months worth of profits in a single day and left the account negative. If it wasn't for the fact that I am familiar with him as a trader, I would have said that this was a trading activity of someone with only a few months experience. I watch his live sessions as I like the way he really punishes his winning trades, and I think there is stuff to be learned there, but I don't trade his system or follow his trades. I do feel sorry for those that do. He should not be posting live, in my opinion, if he can't control himself. I mean, listen, I've tilted before for sure, right? But I don't think I've done anything that bad. That's crazy. Especially for somebody that, like, was famous for mindset stuff, you know? And then you find out, oh, actually, what is he doing? He's like doubling up on losers and stuff. And revenge trading. Jeez. I hate when I hear mindset. You can have your mindset on whatever you want. If you don't know the game and have survival bias, you flirt with adverse selection. Yeah, those are the actions of someone who doesn't know what game he plays. Yeah. Why are you just taking that as true? Well, so the thing is that you can just go and find a stream for that day, can't you? Let's see here. I'm afraid to do it. I need to do a private window. I hate it when, like, you know, you'd search something like that and then it's all up in your algorithm. No thanks. Trader Town. Live. There you go. Wait, the stream is only 1 hour? Okay. This guy's talking like, you know, it was a lot longer than an hour. Here's somebody, his book is not that deep. Well, today somehow he lost control, but I want to defend him by saying that the market was total shit today. No, like, okay, so here's the thing that really bothers me about this. Is in my opinion, if you were trading at all yesterday, you're a bad trader. You don't know what's actually going on. We had CPI today. We have Donald Trump meeting with Xi later this week. We've got Iran tensions going on. So anybody that has money to play with, they're keeping it safe. They're not going to take huge risks ahead of this huge events that hardly anybody can really predict. So it was basically a given that activity was going to be low yesterday and that the market was going to be difficult. So just taking trades yesterday at all kind of says to me that they've got a huge blind spot there. They do not understand the informational side of the market at all. I think the thing that continues to frustrate me about the retail day trading community is that we spend all this time talking about the setups, like these opening range breakouts. And that's not that complicated. I can explain that kind of stuff to you in less than a minute. You look at the first 30 minutes, and when it breaks out of that, then you take a trade. And then, different people have different rules about how they trade it after that, like if it comes back into the range and that sort of a thing, right? But it's not that super complicated. And I don't even know, where is the skill expression in that, right? That's something that I can just program. You can just program it. Well, they say there's some intuition in it. Well, you can program the intuition too, but I digress. Meanwhile, there's the informational side of the market, which is something that really requires you to come in and read the news, watch how the market reacts to the news, watch the order flow in particular as the news comes out. And you have to do that for years and years and years. And everybody just is completely clueless about it. So there's many very, very dedicated people out there that are just completely wasting their time because they're not spending any time on the informational side of the market. So they're missing the thing that's probably the most likely to bring a retail trader some edge, and they're missing half of it. So anything else that you're learning is going to be completely useless because you're missing the most significant half of the market, and you're coming in and taking trades that anybody that's informed know are completely ill-advised. Poker player who has a bad day, he knows what he is doing, he leaves the table. If you don't know who the loser is at the table, probably you are. I made quite a lot yesterday on scalps and ES. I think you can just program it. Actually, I have programmed it in the past and backtested it. And the setup itself, just the raw setup itself, doesn't work. It brings me back to this one thing that keeps coming up over and over and over again, and I think it's just the most bizarre thing. I don't understand why so many people think like this. Is if you have a base setup, which is opening range breakout. So if we are above the opening range, I want to buy. If I go below the opening range, I want to sell. And you might have some other rules about where you take profits, where your stops are, what you do if it comes back into the range, that sort of a thing, right? Those are all straight rules that you can program. So if you go in and you program it, and then if that is not profitable, what makes you think that if you add the right filters and other information to it, that it will be profitable? That doesn't make any sense. That's like you're saying, can we draw this with sets? Basically, you're saying there's this set, which is the opening range breakout trades, and then there's this other set, which is this particular filter, and you're saying that this set overall is negative. This set overall is negative. But somehow in the combination of them, it's going to be positive. Okay. It's possible. But everybody kind of seems to think that that's like a foregone conclusion. No, the most likely scenario is this is unprofitable, this is unprofitable, this is going to be unprofitable. Like the way that the big quants work is they go and they find a set that's a little bit profitable and another set that's a little bit profitable, and they combine like 50 things like this that are all teeny tiny little effects. And when you put those all together, then they make something that's extremely profitable by adding all those tiny edges together. But retail traders seem to think that I'm going to take one edge that isn't profitable and another edge that isn't profitable and put them together, and then somehow that works. And why would you think that that works if there's no empirical evidence that it does? You know? Just makes no sense. Yeah, you can rationalize it and have really felt ground judgment, but if somebody's making money, other people's opinions are meaningless, so the conversation should really just be, is he profitable? But, well, number one, I don't think that he is. To be honest, I think that if you took that, just from everything that I've heard, that what we just read there, and some other threads that I've seen, and people that have tried to kind of go through 1 or 2 months of his trading, I think that if you took the totality of the past 5 years of his trading, that it would not be profitable. So very, very unlikely. Sometimes what you think makes sense and sometimes what makes money. Okay, but you have absolutely no evidence that says that thing's going to work. Here's the thing, is like, you only have one life, man. You only have one life, and you want to make money or whatever your goal is, okay? You're going to have to take risks. How do you decide which thing to take the risk on, right? Because at some point, there's always a little bit of a leap of faith, right? You can know that the market has a certain behavior and that there's an edge to it, but that doesn't necessarily mean that that individual trade is going to make money, right? It could be that the behavior has changed. It could be that it doesn't work anymore, and you're always taking that kind of a risk, right? But what we do is, instead of saying, okay, I'm going to do all of my due diligence, I'm going to prove everything that I can, and then I'm going to work from there and take risks as an extension of that. Instead of doing that, we just say, oh, I'm going to believe what some random person on YouTube told me. It's so ridiculous. I really don't think it's possible, to be honest with you. I really don't think it's possible to have a really popular YouTube channel stay profitable. Like if we started to trade really well, and well, sometimes we do trade really, really well, but a lot of that is sim and things like that. I don't like to take big risk, right? But let's say I'm start taking big risks. The YouTube channel blows up. That would stop working. That would stop working. I would have to stop showing my trades in order for it to keep working. Eventually there would be a point at which it's either it becomes a negative edge because there's so much activity around when I trade, or that I the audience is pushing it up, and so I'm making money, but the audience isn't. Would be actually maybe the more likely thing to happen. So if I had as big of a following as some of these other channels out there, I wouldn't show my trades anymore. It's just the nature of the market. Trading it changes it. There you go. Andre has it right. A conversation about profitability of an unknown set of data is speculation, and not even profitable traders do not make me impressed due to survivor's bias. Yeah, it's true. You know, it gets me back to so one of the things I was thinking about yesterday. I decided against it. Okay, I decided against it, but I thought, what if we just started putting a huge negative number on every video, like every live stream. We made a random number between 3,000 and 30,000 and claimed that I lost that much money that day, because people click on the videos when you lose money. It's absolutely a thing. Like, if you lose, more people tune in. That's absolutely a thing. It would be kind of funny to become popular purely by advertising yourself as a bad trader. I think that would be really, really funny. I don't think I want to do that because, number one, there is some really valuable information that we're sharing here. Stuff that is empirically backed and proven about how the market works, that I think can really guide both day trading, but really any other kind of interaction with the market and the economy as well. It's information that I really think the world would be better off with if everybody knew this stuff. Okay, so I don't want to, we want to keep the brand that we're empirically based and this and that. So I don't think I want to tarnish the brand by doing that, right? But and so as a part of that, one of the things I was thinking, and maybe I'll still do this one, is to talk about trading addiction, because there are some people out there, hopefully it's none of you, but there are some people out there that are just like straight up addicted to trading. And I'm starting to see more and more people, like women, complaining that their men are addicted to trading and things like that. And why does that happen? And I think that in most cases that men, when they become addicted to day trading, they are covering for some other deficiency in their life. Most commonly, I think the biggest one, I don't know if it's like the majority of people or like the most people or not, but it's the one that I think is the biggest to deal with, is that you think that society doesn't value you, is what it comes down to. We have created this world where everybody is so disconnected from their local community. We're all competing on a global scale, and when everybody is competing on a global scale, it's impossible to feel any kind of sense of accomplishment, essentially. And especially if you're a guy that like didn't go to school or you struggled at that, you weren't able to build a real career, because that's I think a lot of day traders, right, is they didn't really go to university, and they kind of got stuck in some sort of dead-end job that doesn't make very much at all, and they don't really have any serious skills to turn into a career. What are you going to do? Day trading is like the one place where there's like zero barrier of entry, and there's still a possibility of making big bucks. So you go to day trading. And we, in our society, we have this whole narrative that like, the market knows everything. There's many people, I see this in traders' profiles all the time, that like the market can't be wrong, but you can. I disagree. The market is wrong all the time. The market is not this all-knowing God that perfectly makes the correct decision in every instance of things. The reality is that it's just liquidity. It's just the orders that people put into it, and that can result in some pretty perplexing behavior. And if you're assuming that everything that the market does is some sort of a reflection of true value, you're never going to understand what you're looking at. And so being successful at trading it, that doesn't make you a more valuable person. People think, okay, society doesn't really value me, but if I can tame the god of the market, then I will be valued. And I really don't think that that's the case. Because for one, you go and you tell people you're making tons of money from trading, there is a very large bulk of people that don't want to hear it, quite frankly. Like that is definitely out there. You ever go on Reddit? Like a conversation that I see almost every week is like, do you tell friends and family about it? And the responses are like overwhelmingly like, no, like don't tell them about it, because they usually aren't impressed. They don't want to hear about it. They'll think bad things about you. And if you do make money, then they want and feel entitled to your money. So you just don't talk about it. That's the first thing. And then the second thing is that to really make significant money day trading from the markets, you have to take huge risks. So it doesn't necessarily speak well of you. When I see somebody, a day trader, that's bragging about how much money they've made, I see somebody that's probably naive, doesn't really understand why they made money, and is a degenerate gambler. They got lucky. So it doesn't speak. I wouldn't go and say like, oh, okay, this guy, he made $100,000 day trading. Should he marry your daughter? I would kind of lean towards no. I would kind of lean towards no, to be honest with you. Because that means he's a massive risk taker. I don't think you want your daughter marrying that guy. Because that's going to be the guy that will, like, even though he's married, he will come on to somebody or sexually harass somebody in the workplace, or get into sex addiction or whatever. Like those are all things that are extremely, extremely common for people that are big risk takers. That's just kind of like male risk-taking behavior. So you don't necessarily want somebody marrying your kid that's you want a little bit of taking risks and smart risks, but not like super huge big ones, right? Brownian notion that sometimes exhibits stylized facts. The result of those facts can be different in the same scenario. Yeah. I mean, there's a bigger question here, isn't there? Is there a pattern that you can find on a day trading basis that consistently brings profits and is available to a retail day trader? I think a purely technical setup like that, I don't think it exists. I really don't think that there's one that would meet like the 5-year time frame. Probably doesn't exist. How do you trade? Well, so step one is you put as many numbers on your screen as possible, okay? And then step two is you just stare at it as long as you need to. And eventually you're just gonna get the feeling like, oh, I need to buy it or I need to sell it, right? And then step three is try and talk yourself out of it as hard as you can. Every possible, explanation for why, maybe this is a bad reason to do it, you talk yourself out of it. And then if you can't, then you take the trade. That's the... Okay, no, the serious answer is this. The serious answer is that markets are extremely statistically efficient, but they aren't very informationally efficient. So what does that mean? Statistically efficient is like there's some pattern and you can analyze the past data and it effectively predicts future data. Nobody has ever found that. There's no peer-reviewed information of such a pattern, even though researchers have been looking for hundreds of years now at this point. Okay. Oh no, my data reset there. Okay. Informational inefficiency is like, does the current price reflect all available information? If we factored in all available information and were able to calculate an exact price, like in the treasury market or in some bond markets, there are some situations where you can objectively say, here's what the interest rate is, and here's all of these other things. This bond is worth X, right? And it will almost never be trading at that exact price. And why is that? Because liquidity. People are coming in and buying and selling, and when you buy a lot of something, it tends to move. It tends to move the asset. The market makers go, oh, there's this guy. There's probability of informed trading. They pull their orders, the market moves up. So the market is very informationally inefficient. So much so that like this edge, informational edges, are just scattered everywhere all the time. There's all sorts of things that you can know. We pretty much know at this point that the Iran war is likely to heat up. Like all of the stuff that we were getting yesterday was basically that Donald Trump was fed up with trying to negotiate with Iran, and they're not sure what they're going to do, but pretty good chance that this ceasefire is not going to last much longer. Okay. Is that priced into assets? I really don't think so. There's no way it could be priced into the equities right now, but it's not reflected. And so that's the issue on the informational inefficiency side, is that the market is so informationally inefficient that you can't necessarily just trade in terms of where are we relative to true value and expect to make money. That's really tough. And so the market is actually the worst of both worlds. Statistically efficient if the market was statistically inefficient and informationally efficient, then what you could do is you could come in and you could just calculate what the correct value was and buy when it wasn't and sell when it's above and follow these patterns, and everybody would be day traders because, you know, there'd be all these statistical inefficiencies that you could take advantage of all of the time forever. Right? Well, what we get is the worst of both worlds. Statistically efficient, so it's almost impossible to find a statistical edge, but it's so informationally inefficient that you don't necessarily make money even when you're doing the right side on the informational side. So what do you do? Well, as a day trader, you're going to have to look for situations where you have imminent order flow. That is a piece of information that you know suggests that there's going to be more orders in a certain direction, like imminently, like in the next 30 minutes, you're going to see that flow. That's what we're looking for. Now, that means that you have to be pretty selective. You have to be able to come in and say, okay, I think that there's going to be a headline about X today, and I'm going to get in front of it. Or I know that this bank has to, just based on what I know about how that bank behaves, that they're going to have to rebalance their portfolio and it's going to result in buying here, and you front run that, right? Those are the kinds of trades that we're looking for. Okay. Explain to us tracking market maker positioning with the inventory. I want to code one in trading view. Okay, so I've actually looked at making it in trading view before, and you really can't do it. I mean, you can kind of do something that looks like it's working, but the numbers that you're going to get out of it aren't going to be very good. So why is that? Well, trading view doesn't have real market depth. So there are some of these guys out there, they have these indicators that are like cumulative delta and things like that. And the way that they're calculating it is they're making a one tick chart. You make a one tick chart, and then if that bar is an uptick, then we say that it was buy volume, and if that bar was a downtick, then we say that it was sell volume, which is not accurate. not accurate at all. Okay. But the way that I calculate it, if you have true level market depth information, or even better yet, the data that we get from Rhythmic that has all of the order flow signed so that you know for sure what's a buy and what's a sell, or, you know, the market order side of it, what was a buy and what was a sell, right? Okay. So you have to get all of that. And then you construct something like a footprint chart. Okay, right? How many buys and sells were there at each price? Except for that, in a footprint chart, you're doing it on like a bar by bar basis, right? Like you say, for this 30 minutes, what was it? And then for this 30 minutes, what was it? What we do is we just have one. We just have one bar that is all of the buys and sells at each price until we decide to reset it. Like we'll reset it at the beginning of a session, for instance, right? Or you might want to reset it after a major news event. Okay. And what we're doing then is we're saying, okay, let's assume that there's a market maker that is responsible for every limit buy order that's been filled. Every limit buy order that's been filled. Okay. And so you would look at that, and if we just look at, let's just assume that what we have on the DOM here is like actually a footprint, right? We can come in and say like, okay, so this guy, he picked up 5,652 contracts at 05, and he picked up 1,250 at 04 half, right? So you're basically looking at everywhere that this theoretical buy market maker would have picked up inventory. Okay. And then we make one other assumption, which is that he takes a profit on that inventory every chance that he gets. Okay. So if he picked up 5,562 contracts at 050, there was 243 at 05 half. So we're going to say that he took profits on those 400 or wherever it was, that got filled on the other side. Makes sense? So he's taking on inventory with the buys, and then anytime that there's a limit, you know, the offer gets hit, he's taking a profit. That is assuming that it's one tick above where he picked it up. Okay. So once you do all that, you start from the beginning and you say he picked up this much here, but then he took off this much here. Picked up this much here, he took off this much here, and you go all the way up at the top. And then will be left with the orders on the bid side that didn't have enough volume on the corresponding offer side to match up, right? And then you take the volume weighted average price of that, essentially, is essentially that theoretical market maker's average price. Which is to say, like here in Jigsaw, you know, I can come in and take on a position. Oh yeah, I'm on the right one. Okay. So like, I'm just going to enter into a position here, right? It will show me I bought and my average buy was at 05. And that's why this 110050 is blue, because that's my average position. And then over here, it shows me how much I'm making on each price, right? So if I were to get filled here at this price, you know, these are going to adjust to say, okay, well, you took one tick profit. So here now, if you were to get out at 050, this is going to turn to 0. And then these numbers are all going to change accordingly because you only have one contract on now. Okay. So this average price is that for what that guy would be showing on his DOM. That's what this solid orange line is, or this solid blue line, right? Depending on whether it's the buyer or the seller. Okay. That's what their average price would be. Now, coming back over here, if you've made a ton of profit on it, better flatten this one because it's moving. Okay, if he had made profit on that, you can get in a situation where it's like, okay, let's say that we're short, but we've booked some profits. It might not show that we're negative until we're past 11. You know, like if I'm using multiple contracts and I'm scalping, one of the things that I'm trying to do is I'm trying to get my break-even point to be beyond the range of the day, essentially. That makes it much more likely that I'm going to make money on that regardless of what happens, right? Kind of gives me more risk. And then you can kind of just let it run and see what happens, right? That's something that really enables you to like let winners run. Yeah. Okay. But that point at where you would be negative, that is what the dotted lines are. Okay. And again, the way that you're calculating that is you're going down, you're starting from the bottom and you say, okay, he picked up this much inventory here. He sold off this much of it. Picked up this much inventory here. He sold off this much of it. And you just go all the way up. So it's actually an algorithm that's relatively simple to explain to you. Like from what I just told you, you should be able to do it by hand. Okay, if you just, add together all of the volume at price for the session and then start doing that by hand. Okay. Programmatically, it ends up being really complicated because you've got to do it this way and then you've got to do it from the other side. And there's kind of some things like you have to ensure that, I'm only taking off inventory from above and that sort of a thing. So I found it to be quite a tricky loop to write and a big loop to write too. So it's not easy to write, but that's how you do it. And we could do it on any platform that is giving you real market depth. I would have done it on TradingView and sold it on TradingView if TradingView actually supported that kind of data. They kind of have like some order flow stuff, but like it's hidden from you. You don't have access to the data things to do it. I made it in Sierra Charts. It was a real pain to make it in Sierra Charts because of the way that their platform is written. But we did it. It worked. That's how it works. That's why we call it the inventory cost basis, as we're saying for a theoretical market maker that's taking on all the volume, what would the average cost, what would the cost basis be for his inventory? And then you do it for the buyer and the seller, and it ends up making some really, really useful lines. I would say not as useful as the volatility levels, but still really useful. Now, I will add that we've done a bit of back testing on them, and I, as of yet, have been unable to find any kind of a statistical behavior around the markets reacting to those levels. Part of it is you're limited on the data, like I only get like a year's worth of that kind of data, that sort of thing. So there may be some as of yet undiscovered behaviors with it. But we do find that the market does tend to play around with those levels. It's just that like the end result off of that you can't predict. So you don't actually get a statistical number that you can really trade with, let's say. I think, we really need to come up with a way to statistically measure the effectiveness of a line. Because I could come in and I could say, okay, here's a line. If the market touches that line, what are the chances that it reverses there or something like that, right? But then you could say, well, you don't actually know if it's going to reverse there, but the market does seem to care about that line. So how do we statistically express that? Because if we had something like that, we would absolutely, without question, be able to see that in our volatility levels. It will bounce off of those volatility levels, hard bounce off of it a lot. So there is definitely some real behavior going on there, right? But how do you statistically explain what that behavior is? I can't seem to figure it out. Okay, this data in one instrument doesn't mean a lot as dealers hedge in similar instruments. This being done on ES, MES, SPY, and some other basket of stocks would give it. Well, so I think the thing is that, you know, the market maker is definitely going to be factoring a lot of other things into what they're doing, you know, but it does seem to give you a really good idea of like what mode the market is in. Like if we're below this line, you know, like especially when we're below these dotted lines, the market makers just like puke it. They are like super wary of picking up inventory below those lines, because that to them is like doubling down, right? So I don't think that you get an accurate enough number from that to really like 100% predict what the market maker is going to do. That's the whole thing, is that what determines where price is going next has more to do with the market orders than the limit orders, right? So yeah, there's a little bit of fuzziness around, you know, how accurate of an explanation is it for market makers' positionings, and then there's a little bit of fuzziness about what that would actually mean for those market makers. But it does do really interesting things. I gotta say, it's like really fascinating. I really wish that there was a researcher out there, like at a university level, that was interested in that and do some research for us, because I find it very fascinating. And we've watched it enough to know that there's something going on there. I'm just not 100% sure. But, you know, a lot of this is, I'm going to give you the tools and you see what you can make with them, right? Because I do not have a mechanical edge on a day trading basis where I can say you go and you find this setup and you take it and you have a better than even chance of making money from it. I just don't have that. And I don't know if we ever will, and I don't really spend that much time looking. But you can find them. You can find them. And if you're going to find them, they're going to be on the edge of what we already know. And this is a place where I think this is kind of more fertile ground, right? It's something that we've got that isn't really very well known, and there's lots of opportunity to study it and see what it's doing. And you can do that in addition to focusing on the important thing, which is the informational side of the market, right? Looking for situations where you can predict imminent order flow. Could be a good idea if you factor in. You know, so on the open interest side, Andre, I don't know if the open interest matters. I think that they, you know, those people that are holding open interest between sessions are not really the ones that you're looking for. That the market makers, they want to reduce their, you know, they want to get rid of all of their inventory at the end of the session, and that's why you see so much volume at the close in the treasuries, right? Is that those guys that have the inventory, they basically negotiate where it is, and one guy makes money and one guy loses money that day. So I think you care more on an intraday basis, and like the longer, you know, like one of the things, so it's kind of interesting when you're thinking about like what are the flaws in this model and things like that, because it's always the case, right? all models are wrong. Some are useful. And I'm saying, you know, I think that there's things about this model that are useful, that we have found useful. The thing that I think is the biggest flaw in the model is that there's no way to account for the market maker taking losses on their inventory. We can come in and say, here's like a simple method for how they would take a profit. But how would they take a loss? Well, one thing that we could do if we had market by order data is we could say, anytime we see those market orders that were converted from a stop, we can assume that that was the market maker puking on some of their inventory. And then we could adjust all of those numbers accordingly. That would be really interesting, don't you think? But, you know, I have the data to do that. So that's one thing that I think that you could do, right? I think another thing that you could do is you could make it a more sophisticated model, because especially if you're doing the S&P 500, they're not just taking a profit on one tick, right? They actually, based on related instruments and the probability of informed trading and things like that, they increase their bid-ask spread, right? So modifying the model so that it could account for a spread, I think would be like another innovation that you could add to it. There's probably a lot that you could add to improve it. Did you back and forward test? Yeah, so when we did it, well, actually what would happen, because I can get like a year's worth of data, I could go through and do some back testing on it and find really, really good numbers. Like the numbers that came out of the strategy analyzer were like the best numbers that I had ever had. By far and away the best numbers. I don't remember what they were, but they were like sharp ratios in like above 1.5 and things like that. Okay. But then when we ran the robot live, it didn't match up. So that's kind of why we started to go into this. Oh, okay. We need to make our own platform and save all of the data so that you can do a bigger test and kind of do some of these more advanced methods to avoid overfitting and so forth. I'm really hoping that I can do something like you know, pass all of the data that I'm typically looking at, like all of the reports and stuff that I'm reading, all of the predictors of order flow that I'm following, and some of those would be like, you know, statistical models sort of things, and some of that would be giving it to an LLM and summarizing it, and then combining all of that information together into something that makes trades. That's really ultimately what I want to do in the long run. That's why we're making our own platform, so that we have a platform that actually supports doing that kind of data science. Will the inventory cost basis be a part of it? I don't know. We're going to try it though. We'll try it. We'll put it as one of the features into the random forest and stuff that we'll use. Well, the market is selling off right now because Donald Trump is speaking and he's saying Iran can't have a nuclear weapon. all the market's selling here. Oil's going up. He also said we don't have to rush anything, which kind of suggests to me Iran is just a question of time. Kind of makes me think that they're still thinking, oh, we'll just let this go on for a while. I say, let it continue to have the blockade, do Operation Freedom to let our stuff through. Squeeze them. I think that if you do that, though, that we'll get to the election and it'll still be a problem. So I think there's some big personal, like, the risks to Donald Trump himself from that strategy. But I think that that's what they're going to do. Wow. The Chinese immigrant mayor of Arcadia, California, has resigned after pleading guilty to being an agent of the Chinese government. Do you remember that last year an investigation was launched into a Chinese baby factory in Arcadia? That city needs to be thoroughly investigated. Ugh. Yeah, so something that's really wild that I don't think people realize is that, you know, if you're like a citizen of a government and you're living abroad, there's always a chance that your government will come in and say, hey, you know, you're still, like, let's say you're an American living abroad, right? They could say, hey, you're an American, you still, you know, value America, right? Why don't you do this solid for us? You do that. That happens all the time. But with China, really, really does it. Like they basically expect all of their citizens to, yeah. So I don't know what you do about that, but you're going to see a lot of stories like that. I probably shouldn't be talking about this, but I can't help but mention it because it was just a fascinating story to me. So a Chinese immigrant becomes mayor. Turns out they were a spy. Well, agent of the Chinese government. I don't know if that we should call that a spy, but China has pretty much their strategy is, oh, we'll have a lot of people immigrate to the United States and then carry out Chinese interests. Yeah. Okay, are we stabilizing? Still looks a little shaky to me. Although I really don't know if like buying it is really the play here. We're getting close. We're getting close to a place where I think it might make sense to take some trades. By the way, why is my see, let's just double check this really quick. That doesn't look right to me. Oh, okay. I think that extended session -2 sigma should be down here, but it gets like they end up at the same price. That must be why. Okay. Wow, really? Dr. Oz says the #1 job in the entire state of New York is personal care services. Almost 500,000 people are being paid to carry groceries upstairs for their parents or neighbors. That can't be accurate. There's no way. I mean, and nobody would be able to afford to live in New York. That was... Investor Mark Andreessen says every big company is overstaffed by 2 to 4 times and has been for decades, and AI is finally fixing it, and this Redditor says. Being an investor is not a job that isn't replaceable by AI. That was a terrible way of saying that, but could being an investor be replaced by AI too? Yeah. I think so. I think so. I think at the same time, though, you're always going to want some human involvement. I'm still not convinced that AIs can completely replace everything. Is Interactive Broker good to use? I don't know. Can you use them with Jigsaw? I don't think you can. Let's see here. IQ Feed, Rhythmic, StoneX, which... Oh, wait, are they rebranding CQG? StoneX? I hadn't heard of that. CQG, Trade-of-8, TT Rest API, Stellar, Bitfinex, JX Feed, IB... Oh, there you go. Interactive Brokers, TWS. Okay, yeah. That's probably okay. Yeah, it's you say that they can, but it's not as good. Oh man, that's weird. Oh, that's funny. Okay, wait. I do this and I can say, let's make a new IQ feed and cancel. There we go. All right. Anyways, yeah, I mean, their market depth data, I'm going to bet, is probably not as good. It's probably not like terrible. I don't know. Like, the thing with the data is that there can be a massive difference in data, but the level of data that you need is like all the way down here, right? So there's some people that are like, well, I have to have trading technologies, right? All other data is trash. Well, it's kind of questionable whether the improvement in quality that you get from using TT is actually worth the money to a retail trader or not, right? So when it comes to interactive brokers, well, the question is just like, what are you doing? If most of the time you're day trading stocks and you need to be able to have the ability to come in and hedge with futures sometimes too, and that sort of a thing, and it all kind of coincides together, well, interactive brokers is basically the only like fully integrated platform like that. At least the one that is open enough for you to use Jigsaw with it, right? But if you want to day trade and you hear that scalping E-mini futures is a great way to do it, and you want to scalp E-mini futures for a couple of days or for a couple of months, and what you already have right now is an interactive brokers account, you might want to consider just getting a futures specific broker, because you will the all of the fees and the commissions and the quality of the data and the quality of the platform and everything is better if you just do futures specific. So now on the other hand, you're using interactive brokers and you insist on sticking with interactive brokers, but you want to be able to watch order flow on stocks. Jigsaw is probably the best way to do it. Like Jigsaw is still the tool that it is, and regardless of which data feed you're using, right? And again, I'm not too convinced that the differences in the data feed is all that important to, has that big of an impact on retail trading. Maybe if you were doing algorithmic trading, then maybe it'd matter. Yes, is thin. Well, I'm gonna bet that a lot of people kind of hightailed it when Trump started speaking. It was kind of funny the way that the market reacted to that, because I don't think he said anything new that wasn't in the stories that we read yesterday and stuff, but they definitely sold it. IRGC operatives tried to infiltrate Kuwait and a firefight ensued. What? Korea sparks market chaos with AI tax threats. Ugh. Excess profits in the AI. What profit? This is so funny to me. That we're also worried that AI is going to replace everybody. The AI isn't even profitable. They're losing money on it, guys. Come on. It may come out that the AI is just so expensive, the cost goes up 10x, and then they go and they say, yeah, you just can't. There's never an instance where the AI is cheaper than the person. But maybe we'll just, we'll still have people that are augmented by AI. It's probably the end result, I think. But what bothers me is, like, before it's even profitable, the very early stages, we need to come in and control it and decide what's going to happen. Why can't they just let things develop organically? Well, if they do that, I think the only people you can really blame is the AI companies themselves, because of the way that they marketed it. Basically, constantly telling everybody that it's going to replace all human workers to try and convince the CEOs to dump money on it. And then, what do you know? The workers didn't like that and fought back. The same thing with like the data centers. Well, AI is like 10 times more expensive than what you're paying for it right now, which is to say that like you're maybe paying $20 a month for it and you should be paying $200 a month for it. So when that cost comes and hits people, there's going to be lots of people that aren't going to pay for it. And the AI companies say, well, it's fine because compute will get better over time, right? Well, not if they won't let you build it anywhere. The public opposes the public opposes building new data centers, new compute anywhere, then you're not going to be able to bring the cost down. What? Zero Hedge has a story. CIA document sparks wild theories of ancient knowledge hidden under Egypt's Sphinx. We usually pay for inference, not the actual training of the model, which is the most expensive part. That's true, but every analysis that I've seen of this has said that if we actually paid for what it costs, and I think that was probably like the totality of it, but that it would be 10 times more expensive than it is. Like, I don't think that the cost is even paying for the inference. And here's another problem, I think, is that the more useful it becomes, the more people are going to want to use it. So, yeah, you might create more compute, but you could also end up in a situation where the demand for compute goes up faster than the supply for compute, right? Because let me tell you what, we use AI at work, and there are plenty of things that we could do, but are not doing because it would be too expensive. Because, like running automated pipelines that are doing AI stuff all the time. So the usage could be easily orders of magnitude more. if That's the truth. The infrastructure that we have, even with the big data centers today, is not as effective as we would need. It's like the engines in the 20s of big 7 liters for 45 horsepower. I do kind of wonder if there's going to be this point at which they say, the AI can never be cheaper than a person, because the human biology is just more energy efficient, right? I think there's this idea that, like, well, you get all of this compute together, that it can be faster and more efficient than a human. But I think that they're kind of taking that as an article of faith and not actually really know that. Well, this is why the chip makers are making tons of money and not the AI providers. They're the modern day picks and shovels. Yeah. I really don't think, since the beginning, it's been everybody wants to invest in OpenAI and Anthropic. That OpenAI and Anthropic are going to own everything. That the robots will just take over, automate all work, and then we'll just have to tax OpenAI and Anthropic in order for people to live or whatever, right? And I really think that this is an idea that, the founders of those companies have kind of pushed, that doesn't really have any basis in reality. I really don't think that scenario makes any sense at all. And what you're seeing right now is that the AI companies are not the ones that are making money. They're losing massive amounts of money because what they're doing is so expensive. And then at the same time, there's other people doing essentially the same thing that they are doing, but for cheap. You know, like making local models and things like that. So if it really costs 10 times more than what they're charging for it to make it, how are they ever going to make money if there are other people supplanting them with models that are basically free and you just have to use your own hardware? Right? So I think you're right. The chip makers, well, now on the chip maker side, the issue with a chip maker is that, like, making the next generation of stuff is insanely expensive, right? Like, every time that Intel makes a new generation of CPU or whatever, it's basically like overhauling their entire factory. They have to take like all of the profits that they've made and invest that into the next generation. It's something like 80%. It's insane, right? So chip makers NVIDIA is making money now, but in the long run, they might not be the best play either. And I really think that if anybody's going to make money from AI, it's going to be the small businesses. So this is exactly the opposite of what everybody on Reddit is saying. This really, the problem is the discussion is so dominated by the Reddit brains out there. You don't get anything else, right? But I think that you're going to see the rise of a new class of people that are starting their own businesses that they wouldn't have been able to make without AI. And that those are going to be the people that benefit the most. I tell you what, I've been trying to do stuff in the startup world. Because, you know, Utah has startup stuff. They have events and stuff. I haven't really been able to get out to events, but I've been able to get into groups and talk to people and stuff. And there are so many people out there. They all have their idea, things that they're building. Now, I think that it's always the case that, like, most ideas are bad ideas. You know, probably most of them won't be successful. But I think that when you look at like the number of startups that actually are successful and everything, it's probably still going to be like 2 to 3 times what it is today. And you're going to start to see a startup kind of culture like you had in San Francisco and you have in Utah now. And that's just going to spread everywhere else. And that's going to be the new class of people. And for the rest of the population, well, like your middle class, they'll have more opportunities because there'll be more jobs. And your working class, well, there are less and less skilled people, so the working class people will probably make more too. I don't know. I can look at this and game it out and find a way in which every group of people benefits. It is possible. Instead of this doomsday scenario, everybody's always constantly. Well, should we read about the CIA and their wild theories about the Sphinx? Because, you know, there's interesting stuff about the Sphinx, but I'm surprised that the CIA is talking about it. A declassified CIA document that references a temple under the Sphinx in a 76-year-old photographic inventory has reignited interest in a mythical hall of records said to lie beneath Egypt's Great Sphinx. You know what? I think that there actually is. I think that there is a hall of records somewhere underneath of there. I don't know if you'll be able to pull anything out of it, but it will be like one of the greatest discoveries ever. But I think that the people in Egypt that are in charge of those things are preventing us from getting it. Because they think that if it happens, that the Egyptian government would destroy it. Something like that. Like, because it would be inconvenient to certain religious narratives. We read on. The document in question is a CIA inventory cataloging black and white photo negatives from July of 1950. Among routine entries such as Sphinx tourist at pyramids and ruins near Sphinx appears the line Temple under Sphinx, July 50. Okay. The phrasing has prompted renewed discussion about possible hidden structures beneath the Sphinx, a topic long associated with Edgar Casey's prophecies of an underground hall of records containing ancient knowledge. Well, I don't know if that's really enough of a story to clickbait me and read it to all you guys and all this stuff. The Hall of Records describes a repository of Atlantean or pre-dynastic wisdom hidden near the right paw of the Sphinx. While mainstream archaeology has not confirmed any such chamber, the CIA reference added a new layer to existing theories. This development ties directly into earlier reports of a potential subterranean features at the Giza Plateau. Last year, we highlighted claims by Italian and Scottish researchers using synthetic aperture radar scans that purported to reveal a vast underground complex beneath the pyramids. This goes on way too long. I'm going to read all this. Oh, I didn't read Rock's Neutrino's other comment. Then we're back to the status quo. Yeah, probably. I don't know. I mean, every time that we get a big technological innovation, people's quality of life improves. So, I think that that's going to continue to happen. And I'm worried that AI is a great development, that it's going to create tons of jobs, and that we're not going to have enough jobs to fill. Like, one of the things that kind of is weird to me is that when this all started, some people were saying, well, you need to get the new developers that are like AI native. But that is not happening or working because, one, it turns out that you need to have a lot of experience to use the AI very effectively for development. And two, the kids hate AI. They are so worried about the AI just completely destroying their future that the younger generations, like the kids graduating from high school right now, just absolutely despise it and are doing everything that they can to undermine the rollout of AI. So you're not getting that younger generation. Who's going to do it? You know, like if it turns out that actually it's just a productivity boost and an improvement to everybody's cost, standard of living increases across the board, there's going to be all these people that don't have the skills to take advantage of it and make money from it. They chose to pass on it because, one, they didn't want to learn the AI, and two, they didn't want to learn the deeper skills without the AI. So you'd just be stuck with millennials. They won't be able, millennials will never be allowed to retire. That's what's going to happen. They're going to be like, hey, millennials, you know how we told you that when you become 65, that then you can start drawing on your IRA and your 401ks and stuff like that? Well, it turns out that if you start doing that and stop working, that there won't be anybody to work or do your jobs, and the market can't hold it because there's not enough other people buying, so you just can't touch it now. Andre says it's fun to see how some people hate AI and would not use it for anything, and if they see you using one, they turn hate on. Yeah. So a coworker was telling me yesterday, because he's been building phone games using AI, and I mean, he knows what he's doing, and he makes good quality stuff with it from what I've seen so far. But when his daughter found out that he made it with AI, she was so upset about it. So upset about it. That's wild to me. Or that video that we watched yesterday where this lady says like AI is changing everything, and they booed that. And I've had these conversations with people that are like, oh, the AI is still trash at everything and blah 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 blah. And it's really wild to me to read this stuff, because in my world, it has already changed things. It is I think software development is forever changed. I kind of wonder about this, like this whole, the costs and all of that sort of a thing. Because if all of the sudden tomorrow it shifted back to you can't use AI, I just can't imagine that world anymore. Like once you've turned it on, I don't see, nobody would want to go back. It's just, it's so much more engaging and convenient. And you know what? With the way that we're using it, it's not slop. If anything, the AI makes the software that we're developing better than we ever would have imagined to have made it ourselves. But that's because we're reading all of the output and reviewing it at every step of the process, and we're injecting our own knowledge and information to the LLM, right? Things that if you don't already have the knowledge and skills, you can't do. The millennials seem to be the richest in openness. Looking at things like this, boomers and Gen Z are kind of similar, but at extremes. Millennials use every information point they can in general. Okay, so this reminds me of some other thing like related to that kind of weirds me out. Do you guys remember the times when like everything was blamed on millennials? Oh, this kind of a business doesn't work anymore because millennials don't like it, and you know, the blaming. And then there was like, millennials are difficult to work with. They're not, you know, managers don't know how to deal with them because they have different expectations and they don't want to work hard and all of these sorts of things, right? And now, of course, you see that same thing aimed at Gen Z, Gen Alpha people coming into the workforce. But there's two things. One is that, well, now millennials are the ones that want to work hard. And in fact, I see a lot of people like communists and stuff saying like, you millennials, you fell for it. You work too hard. You give too much to the corporation, yada, 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 yada. But then on the split side, like, you know, because they claimed that millennials were lazy and everything, they still hired millennials. Millennials found work, and millennials are set to be the richest generation ever. And they're going to inherit all of the boomers' wealth, and in addition to that, so it's going to get crazy. There's going to be a wide bifurcation in outcomes, though, because there's going to be some millennials that are going to do really well, and there's going to be some that they were kind of left behind, right? Like they didn't get into a house soon enough, they didn't find a good career, and they're going to be hurting. So even though the generation overall is going to be the richest, let's not just say that everything is perfect, right? But that's not what's happening for the Gen Z. Like, for the Gen Z, they really are just not hiring them. Or at least they're hiring less of them than ever. Maybe that's just a temporary... Maybe that's just a temporary economic thing. But I'm concerned. I'm concerned for the younger generation. Why is it that millennials all of a sudden became the corporate shills, but then Gen Z, Gen Alpha, they're literally just not getting hired? Or they get hired and then they're immediately fired. millennials are on top for substance abuse. Oh, I can buy that one. You know, it's just popular culture. You know, I think that the windows that I have, it's a weird thing because in some respects I have a big window, right? Like I'm on the internet a lot more than other people, so I have a really, really good feel for what people on the internet are saying, at least on TikTok and on Reddit, are the two places that I visit the most. And then I get an idea of like what's going on from my kids, but there are definitely still blind spots there too. What are you seeing and not seeing? Well, one of the things that really bothers me about popular culture is that they don't take substance abuse very seriously. Like, if I get on Reddit and I start talking about, oh, you know, I want to go and take ecstasy or marijuana or whatever it is, right? There's not going to be very many people there saying like, that's going to be really bad for you. You shouldn't do that. Here's why. You're not going to see those comments. They'll all be encouraging, almost all of them. So millennials just went full bore into substance abuse, and it sucks because I tell you, a few things will destroy your life more quicker than substance abuse. They all think, oh, look, marijuana is a harmless drug. It's not a harmless drug, man. You want to be a loser, smoke weed. And if you're a pothead and you're offended by that, good. So this is another thing I've been going. So yesterday, I don't know if you guys saw this on my TikTok, but somebody was saying like, the modern dating is like a marketplace. And what has happened is you guys have pushed the bid up too high. You swipe right on everything, and so the girls think that they're super in demand, and that's causing all these problems. So what you have to do is you have to lower the bid. So I made a video that's basically like, it's not just an analogy. It is literally a marketplace. You see the same kinds of behaviors go on in the markets. And what this guy is saying is absolutely correct. That if you're bidding up a certain commodity too high, that you want to fix that imbalance, you have to stop buying it. You have to stop bidding it up. Right? But I said it in like the most offensive way possible I could think of, which was basically like, okay, so like if you're on TikTok, Tinder, stop thinking that you're on the booty call marketplace. That's not the market for you. You want to go into the I want a life partner marketplace. So when you get on Tinder, you see somebody that has all of those warning signs. They're communists, they've got a nose ring or whatever other kinds of like signs of emotional problems that they have. Swipe left. Unless you can picture that woman raising your kids, don't even entertain it. And then, yeah, there's going to be a whole group of women that are going to be super upset about you saying that and are going to be, you know, they're going to die single. And I say, just let them. They can have their cats and their wine, and the rest of us can continue on society. That's what's going to happen. And so I posted that. And TikTok definitely throttled it. Okay, like you should get like 100 to 300 views on anything, right? I put that out, immediately only 50 views. I only get 50 views on that. So as soon as I go into that, I think that it's like anytime that I stitch somebody TikTok decides we don't let Seth do stitches or something like that. But it just kind of makes me want to do it more, to be honest with you, because I'm kind of getting sick of a certain viewpoint being like, you can't say that. You can't say that. And like that viewpoint not being represented because like somebody has to have kids and raise the next generation of people, you know. That's an important thing. It makes me want to say all of the offensive, politically incorrect things, even if it's not in line with the rest of my content, and even if the audiences want to hear it. So the other thing that makes me feel like that is the results of the recent British elections. See, the way that a democracy works is that people vote what they think is in their interests, and that forces the politicians to have to think about and help everybody, or at least a large enough of the population to have a majority. And what's happening is they kind of said, okay, we think we're smart. There's this group of people that are smart. We're just going to do everything that is in favor of the smart people, and the dumb people, they can either get along with it or get left behind. And what happened? Well, there's more people left behind, and they vote against you. Maybe they're not smart. Maybe they have some ideas that are really dumb, but they can still vote. That's the way the democracy works, right? The democracy is not intended to create the best, most perfect idea, or to give power to the smartest people that they can just go in and, you know, do everything that they just make the perfect society from all of their college educated goodness. No, the system is designed to ensure that everybody's interests are taken into account. That's why it's bad to disenfranchise groups of people. You just say, oh, they make bad decisions, so we should disenfranchise them. And then that just means that now you can make all of these decisions that hurt those people, and there's nothing they can do about it. So that's why you need to have the representation. And the elites in the UK and in Europe and in the United States, for that matter, don't seem to understand this. They seem to think that everybody should be voting for them because they're the good, they're the most righteous, and they're the smartest, and yada yada yada. And it doesn't work like that. Another way of putting it could be, I heard this from somebody was talking to the guy that made Wolfram Alpha, and he said that the reason that nature works is because it has a really loose objective function. That basically, if you survive and reproduce, those are the genes that get carried on. And so that there's a lot of leeway in that. There's lots of different ways that you can do that, right? The objective functions that we put in our social media are too narrow. The kinds of content that we allow to be successful on social media, it's too narrow. But democracy is the same way. To become politician, you've got to get enough people to vote for you. And there's lots of different ways that you can do that. And it doesn't necessarily have to be from being the most correct. But people do tend to vote in what is in their immediate best interests. So you can't just say, oh, we're going to make everything be good for the richest, smartest, most educated people. Leave everybody else behind. They're not going to allow that. Which is also why this whole scenario that people keep dreaming up about AI is just not realistic. Right? If it really did come down to that, then all these scenarios we were talking about, you won't be able to build the data centers. You won't be able to, the people will stop it. And you're already seeing people respond when they think that that's going to happen, even before it's actually happening. It didn't say anything interesting about it. Maybe I didn't. That's things that are interesting to me. One of the things that I think is really weird is that it seems to me there's all these people out there like saying like just the absolute craziest political stuff, and they get super popular from it. And then when I say things that I think are a little bit off, like, nobody cares. It's fine. Nobody cares about downside anymore, says Zero H. Talk about, well, see, this is the other problem, is that okay, here again, I'm in the mode. I'm just gonna say what I'm thinking. The problem here is that your idea about what trading is stupid. Yes, found resistance. Okay. I think that's funny. Well, because first of all, like, is it? Yeah, like, kind of turned around down here. Doesn't seem to have done it. Well, actually, there was extended session. Extended session volatility level, but I really don't think that gives you anything helpful. I want to scare all of the support and resistance technical analysis degenerates away as quickly as possible. We here on this channel, we talk about empirically proven behaviors of markets. I make no promises. I make no claims, except for those that I can prove with peer-reviewed empirical evidence. And yet you say, okay, so here's somebody else says, I made $100 on that scrap. Good for you. You might be stupid, but you're lucky. Good for you. I don't care if you made money on it or not. Especially not on one trade. Hey, this goes back to the thing we were talking about earlier, okay? If you have 5 years of that, you've been doing that for 5 years and you made money every year of those 5 years, then we can talk. I saw the DOM. Well, we use empirical data, yeah. There are some things that we can glean from the DOM. I tell you what, there's a lot of stupid shit out there in the order flow world too. You know, the most proven empirically, like, shown in the literature behavior of order flow is the autocorrelation of order flow signs is what they call it. That's I use that term not to confuse you, but because if you want to search on the internet about this, that's what you need to look up. Okay, it's the autocorrelation of order flow signs. But basically, if I come in and I pick a random order and it's a market buy, and then I come back and an hour later I pick another random order, there's a 0.5% chance greater that it will also be a buy. Autocorrelation. And this, we believe, at least, is because of large meta orders executed over time creates those kinds of imbalances, right? So that's like an empirically derived behavior that you can actively see in the markets, and you can see it from the data and like when it's happening and stuff like that. and you might be able to use that to your advantage, right? But then people will get focus on these other things like various setups on their footprint charts, like an unfinished auction. That's one that's really popular. If it's an unfinished auction, then it's likely to go back to that price. It's not. If you go and you test it, there's not a statistically significant edge there. So why does everybody believe it? I think that what happened is like somebody created the tool and then somebody thought, oh, okay, then maybe we do this. And then they did it and they made enough money enough times that people thought, oh, it works. And then it kind of becomes part of the lore and everybody believes that thing and teaches it to each other, even though there's absolutely no empirical backing behind it. Oh, it's AM Profit. Yeah, I remember you. Or I remember that name at least. Got 30 minutes left. Hold on. Oh boy. Okay. We're going to try and get the kid to school. Treasuries are kind of dead. I think that the play there would probably be to buy it, but I don't think... I bet you that it's probably going to do something like this. You know, and then maybe like go nowhere. So I think that you kind of got like a... you could maybe buy it here, and especially buy it if it goes down here. But the reward's not going to be too much, so I don't know if it's really like a very good risk-reward trade. But I do think that there's a better than equal chance of that happening. Because of volatility, right? That's what that is. I don't... That line doesn't just come from nowhere. It's from volatility. Or that's what they're pricing for volatility. So...
Block
and in
sell.
the S&P 500, they kind of look to me like they're still in a sell mode. In fact, that was just a new low. So if you bought that resistance or whatever, oh, maybe he means resistance by like the overnight price. But I think that what's actually going on is that the market is concerned about Iran because the price of oil is moving up. We may as of yet have fireworks today. Let's see. But I'm gonna see if I can get my child on the bus.
Block buy.
Okay, well, man, so 9:30. Yeah, he didn't want to get on the bus, so I dragged him down to school and down to the classroom, and then he tried to keep me there. So it took a while to break away. I am shocked, though. Should I say shocked? I don't know if I would say shocked, but we have been stuck at 0.2 in the 10-year treasury for over an hour. That's crazy. Is there something else happening today that I'm not? Because that seems a little odd to me. There's a 10-year note auction today. That might do it. So there's a rate lock at 110.02 half. That's curious. I wish I had known that earlier. Although there's no way that I would have guessed that it gets stuck there. We didn't even get 153,000 contracts. So maybe. There might have been some big icebergs there at the beginning that might have told us that it was going to do that right there that I missed. But looks like Spoos kept going, though. And is there any of you still with me? Probably not. Oh, wow, one. That's crazy. Well, for the one person that's still here, thank you. Boy, we'll see you guys tomorrow. Stay excellent.